What the investment team aims to do is to create and maintain a diversified portfolio that has a long-term focus. Diversification is key in any kind of investment activity. We want to make sure we don't have all of our eggs in one basket. We want to have exposure to many different types of assets, different asset classes, geographies of the world, sectors of the economy, currencies, and outside investment managers that we're also bringing in their skill to work alongside us. And that long-term focus is really about compounding returns over the course of many years. We want to be engaged in positive sum games alongside our external investment managers, where we're really generating long-term value creation. We don't want to be engaging in speculation within the investment portfolio. When we think about risk in the investment portfolio, the key word really is mitigation rather than elimination. We'll never be able to avoid taking risk as long as the plan is open and we need to grow the assets. We think about risk mitigation as operating primarily through the diversification within the investment portfolio. Again, making sure that we're spreading out our exposures across different parts of the economy, different types of asset classes, and so on. We also think about what's the overall level of risk that we're taking in the portfolio, and again, we're calibrating that to try to match the expected growth rate of the benefit obligations. And then we're also paying a lot of attention to availability of cash. We pay the benefits out of the investment portfolio. We need to make sure that we've got access to sufficient liquidity at all times so that those checks will clear. We think the portfolio is pretty well positioned at the moment to generate the returns that we need to achieve over the long run. Our calculation is that if we can make about 7% on average per year out of the investment portfolio, we'll be positioned pretty well, and we think that the portfolio is set up to do that. Now, we know that the portfolio will fluctuate from one year to the next. We don't control the state of the world or financial markets, and so we know we'll experience a mixture of good years and some not so good years. The expectation is that over the course of 5 to 10 years, those returns will average out to something like 7%.